An issue made to less than 50 investors qualifies as a private placement. It is not governed by SEBI regulations for public issue of shares and debt. Preferential allotment is a type of private placement by a listed company of shares or securities, which can be converted to shares at a later date. For example, fully or partly convertible debentures. QIP is a private placement of listed shares to qualified institutional buyers, QIBs. QIBs can be financial institutions, mutual funds, or banks. Qualified institutional placements have a lock-in of 1 year. Investors cannot sell shares except on a recognized stock exchange. IPP is a type of private placement of listed shares to raise minimum shareholding. Browse through other details mentioned on these slides about private placements. SME issues are issued by entities with capital up to 25 crores and whose post-issue face value capital is not greater than 10 crores. Minimum application size is greater than or equal to 1 lakh rupees. Go through their filing process and other details of an SME issue as given on the slide. ITP is a specific platform for companies in a specialized industry where at least 25% of capital is held by qualified institutional buyers. Other companies where 50% pre-issue capital is held by QIBs can also use this platform. Pre-issue capital is locked in for 6 months. This platform is specifically designed for HNI and institutional investors. Before we move to the secondary market section, let's proceed with the challenge. The challenge question is to introduce shares to the secondary markets, whether promoters need to raise additional capital. The two options are yes, fresh capital issue is required to enable trading on stock exchanges, or the other option is no. Secondary markets facilitate primary market issues, which means promoters do not need to raise additional capital. You will get 5 seconds to figure out the answer and we'll resume after that. Welcome back. Let's see which is the correct answer. In case you chose the first one as the option, it would not be correct. The correct option would be no. Secondary markets facilitate primary market issues, which means promoters do not need to raise additional capital to introduce shares to the secondary markets. Now with this understanding, let's go and delve deeper into other details about secondary markets.